Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumeet Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. And I want to put in another plug for our ETF.com leaders, the top financial advisors and registered investment advisory firms. You have until the end of the month, the end of July. The clock is still ticking to get your nominations in there and get yourself positioned on this list.
Definitely check that out on ETF.com. In this week's podcast, we're talking with Brendan Ahern, the Chief Investment Officer at KraneShares, a China-focused ETF issuer. Brendan, great to have you with us.
Yeah, likewise. Thank you for the opportunity.
Absolutely. So, Brendan, let's start by talking about the biggest story in the U.S. today, at least on a national level, which is the election. Why should investors buy China ETFs when Trump could be elected president in a matter of months? Isn't that a big risk considering the tough on China policies that Trump has been in favor of?
Yeah, I think we got to remember that there is a difference between rhetoric and reality. And I think politicians in general, when you put them in front of a TV camera or in front of any journalist, they're going to speak to their base. They're going to play to popular themes. But I think that's very different than the reality of how intertwined these two economies are, both in terms of trade, but also the interdependence from an economic perspective. I mean, if you're really worried about, tariffs or shouldn't we be selling our Apple, Tesla, ExxonMobil, Boeing, Nike? I mean, there's a whole host of U.S. multinationals that are highly dependent upon China as a percentage of their revenue. And yet those names are kind of immune from some of this rhetoric. And yet, which I think shows that the market is aware that a lot of this is rhetoric. It's just not actual policy. And particularly for Trump, I think this is the art of the deal. This is negotiating 101. And I think the Chinese are more than happy. The Chinese government is more than happy to re-engage and do another deal, which arguably is an improvement from the Biden administration, where there is no deal on the table. So it's counterintuitive, but we're actually would think Trump is arguably better for China than the current administration.
Yeah, it's interesting, Brendan. You referenced some of the tech stocks that I think you said are immune or have been immune. But here we're recording today on July 17th, and the market opened today down. Pre-market trading was down based on some of that rhetoric. Nvidia was down, I think, almost 7% at the open or something like that, and it was a lot of spreading of that. But if Donald Trump follows through, let's say he's elected, he follows through on his promise of putting tariffs of 60 to 100% on Chinese imports, what would that do to China's economy and by extension Chinese stocks?
Well, one, the ownership of Chinese equities is quite low. And now, even within all country world, China's 2.5%, if that. So investors' net exposure to China is really, really small. And again, that's where if you're so worried about some of this rhetoric, you're far more exposed to these U.S. multinationals that have very high weights. But the actual effect is a little bit smaller. Part of that, and interesting, is that during COVID you had these supply chain problems, but from a Chinese company perspective, that was a revenue problem. So some of the China plus one strategy is actually being driven by Chinese companies, and Chinese companies have said, if there's Chinese government policy like a COVID lockdown, I can't get my stuff to my end customers. shouldn't I have a factory in Vietnam, Indonesia, Malaysia, Mexico, even here in the United States? And so it's interesting that the Chinese companies, from just wanting to make money from selling to the US, to Europe, across Asia, have really led the China plus one strategy. Again, I would say the the biggest worry for any investor about 60% tariffs is your ownership in Walmart, Costco, Home Depot, which basically, or even Amazon, which basically import a lot of this inexpensive goods from China, which in order to make are highly polluting. And so, we kind of outsource our pollution to these third world countries, these emerging markets, if it's China or India or Bangladesh. So we have nice, beautiful blue skies, and this idea of bring it all back, let's put a rare earth processing plant and with the first person who wants to bring it all back, and you're going to bring back asthma, lung cancer. It just, we're, we're outsourcing our pollution to others, and they do it less expensive, and that's not going to change. So again, we're very, you can tell I'm very, dismissive of some of this rhetoric, some of this bring it back. It's just not economic reality.
Really interesting point, Brendan. So obviously, Trump's rhetoric with regard to the tariffs and things like that is one thing that's been on investors' mind when it comes to China. Another thing that's been on their mind is this whole Taiwan situation. I read Trump's interview with Business Week this week, in which he said he wouldn't necessarily offer unconditional military protection for Taiwan. And that has people now worrying that that might encourage China to invade the island. Do you see that as a risk?
We've been in general dismissive of a China invasion of Taiwan. The ties between China and Taiwan are very, very strong from an economic perspective. It's a very complicated issue if you actually look into the history of the Opium Wars and the events that actually led to World War II is how Japan took over Taiwan back in 1900. So it's a complicated issue. But the reality is that I think what Trump is really saying is he wants Taiwan, no different than our European allies, to pay their fair share, that US taxpayers have subsidized the protection of Europe, the protection of Asia, if it's Japan, Taiwan, or Australia. We as taxpayers are paying for these other countries' defense. And I think what Trump is really saying is you gotta pay up, no different than Europe and others. So in terms of I don't think he's saying giving a green light for China to go in. I don't think he's saying that at all. He's been respectful of the traditional U.S. policy to Taiwan. So we've been very skeptical of that narrative. I mean, one of the things I always recommend to people is there's a thing called Kinmen counties. So Kinmen County is off of the main island of Taiwan, right? Taiwan sits 100 miles from China, or 90 miles. But Kinmen County is part of Taiwan, I'm sorry, and it sits 3 miles off the coast of China. I mean, literally from this island, you can see China. I mean, a guy actually defected to China by swimming. And if you use Google Maps, you can see people live there. And so I think again, some of this rhetoric, it makes for great media. I mean, people, we click, we read, but I find it very skeptical. And I think there's no greater evidence that if people in Kinmen County thought China was about to invade, that is the last place on earth you would live, and they live there because they don't buy into the narrative. And having visited Taiwan, I think the vast majority of the people I met with were very, they actually would say, those are our brothers and sisters. Those are our aunt and uncles. Why would they want to hurt us? I think this is about, selling defense goods to the Taiwanese government.
Okay, so it sounds like you put the odds pretty low of China invading Taiwan. But hypothetically, what would that do to investors in Chinese ETFs?
Well, I think it would be, well, it would quickly become a regional, if not global, war. I've heard people say, well, we're underweight China, but we're overweight, Japan and South Korea. Well, that would very quickly become a very, very big problem, which is why you hope kind of cooler heads prevail. It's good to see, the militaries are back talking to each other after the Biden G meeting in APAC. So, it's you would have a very big problem because if it's 16% of Apple's revenue comes out of China, if it's 21% of Tesla's revenue comes out of China, 12% of ExxonMobil's. I mean, Boeing without China, in terms of commercial airplane sales, is a very so you've got a very big problem. You have a very big problem, which is why we've always contrasted how well corporations get along with one another globally, and the politicians haven't been able to. And obviously, it takes two to tango here. So I think we all should pray and hope that, because the last concern of anyone in that scenario is about a China ETF. Your entire portfolio has a very significant problem because of your very large overweight to U.S. equities, but also you've got a big really a global event, which is part of, again, why we are very skeptical, or have been continue to be very skeptical of that scenario playing out. The consequences, particularly from the China perspective, if you saw what happened to Russia, Russia had nothing to lose going into Ukraine. It's not a globalized economy. It's got raw materials, oil, nickel, etc. China's economy is totally geared to the West, and so it just would make no sense. If China's biggest customers are the U.S., Europe, Asia, if you're cut off from the global economy, the Chinese economy would instantly collapse, which is where regime change occurs. So yeah, it's hard to do the mental math, the kind of game theory of how that would be a good thing for China. It seems like there's zero upside to that scenario.
That makes a lot of sense, Brendan. So we've talked a lot about the potential for a Trump presidency and its impact on China, but what about the status quo? You mentioned, Biden being reelected, that might be worse for the ETFs. Do you think it's dramatically worse, or the two scenarios are the same?
I think one, anyone that's been worried about geopolitics has left the space a long time ago, and that's part of why we're more constructive. Is just you've had this wind down of the exposure, so everyone is out of the space. I mean, if you're worried about Trump or Biden or you're long since vacated. And so in terms of upside potential is much, much higher today in terms of the rebound in Chinese equities. In terms of the Biden administration, I think it's been hard to understand who's running the China policy. Is it Blinken? Is it Yellen? Is it Raimondo? Is it Catherine Tsai? There's not really an articulated strategy, which again makes it hard for China. China did a deal with Trump. There's no deal on the table from the Biden administration. So I think they, that's why, you might say, maybe they would prefer to deal with Trump. They did a deal with Trump. Do another one. With Biden, there is no deal on the table. Maybe again, for both Biden and Trump, it would be their second term. There's not as much pressure. It's more about their legacy, and so maybe that would change with the Biden administration. But we've really not seen any indication. And even in today's news about limiting, a company like Tokyo Electron, they do 44% of their revenue to China. I think the US is something like 18%. So if you're going to force them to choose, who would they choose? Would they choose doing business with the US or doing doing business with China? In the case of ASML, they did 26% of their revenue in China versus 11% to the US. If you force them to choose, you might not like the answer. And just on this Tokyo Electron, is 44% to China, 9% to the US. Just want to make sure I got those numbers correct. So again, China's economy is very globalized, and that's a two-way street, including US multinationals. So yeah, that's where you hope some of this TV rhetoric, behind closed doors. I think, why is Elon Musk so involved with the Trump campaign? 21% of his net worth is arguably in China based on the amount of revenue Tesla has. Would Jamie Dimon be, who's had very good, very strong comments about the necessity of China and the global economy. If he were to be the Treasury Secretary, I think that would be a good thing. It's a cooler head.
If you're a financial advisor and you want to hear the latest insights and strategies in portfolio management, make sure to also subscribe to Advisor Upside, available wherever you get your podcast. Let's talk about another little wrinkle with regard to China. The demographics. Chinese population declined for the first time in modern history. What kind of a headwind does that present for China's economic growth?
Yeah, it's interesting that the Japanese economy or Chinese stock market actually bottomed at their peak inflation. So for over 10 years, Japan's population has been decreasing. It's down only about 2 million people. And yet their stock market has done nothing but gone straight up. In terms of demographics, the country that's actually in the worst spot is South Korea, which has the lowest birth rate of any OECD country. It's down to 0.8. Also, I'm sad to report, South Korea has a very high suicide rate. You might remember that movie Parasite, where the lead actor won the Academy Award. He actually killed himself. I don't know why South Korea has such a high suicide rate, but the reason, at the same time, Samsung is one of the best performing stocks ever, despite a absolutely horrific demographic outlook. Now, why is that? Now, one is South Korea and Japan are export-driven manufacturing countries, similar to China. So if you're an export manufacturing-driven economy, it's more about the demographics of your end clients as opposed to your domestic. That South Korea, China, Japan, the domestic economy is less important than the export manufacturing. So one, just based on the makeup of China's GDP, their lack of self-sufficiency from a domestic consumption perspective makes domestic consumption less of a concern. China has urbanized. So whether you're in Shanghai, Rome, Tokyo, or Seoul, or Manhattan, if you live in cities, having these kids, is tough, right? They're expensive. Like how do you have 3 kids in a 2-bedroom apartment? You don't. So an unfortunate consequence of global urbanization, including in China, has been declining birth rates, and there's obviously other factors, women working in the workplace, but the biggest thing working against China is the lack of suburbs. And so I think the Chinese government is very aware of this problem. And yeah, if you take the current birth rate and go out 100 years, yeah, sure, China's half the size, but there's someone who is aware of it and will do something about it, which is the Chinese government. and they are very aware of this issue. And I think simply the building of traditional suburbs like we have here in the US is the very simple solution. And with China's high-speed rail, they're actually more conducive to a commuter nation than the almost hour and 20 minutes I spend on the train. Even though I'm only going 30 miles. So anyway, so yeah, it's the issue. I think it's a little overblown, and without immigration, guess what? The U.S. has a real demographic problem as well.
Brandon, we've talked a lot about the risks when it comes to investing in China. Now, let's turn to the other side and let's talk about what could go right. Obviously, China ETF prices are pretty low today after several years of underperformance. What could make them go up from here?
Yeah. I think, one, you'd say, January of this year, you had this liquidation event, this that took place in the China markets, and we do believe that marked a low. That this was the last long being forced out of the market as markets kind of rolled over. That a little bit of a derivative induced meltdown, but we think that pushed the last buyer of hope out, and we've had a rally since then. There's been a pullback since mid May based on some lower mixed economic data coming out of China. But why we're more constructive is that there are some positives coming on the horizon. And first among that would be you have in June a big e-commerce event. They call it the 618 event, and those numbers were actually pretty good. And those numbers will show up in Q2 earnings, which is going to occur in August. We also have some government policy meetings taking place where we think there might be an amplification of further policy support. They've been very conservative in terms of policy support, just they haven't wanted to go further in debt or create inflation. But we think that this latest round of kind of mixed data, they really need to get going on getting consumer confidence back up. It's been quite tepid due to declining real estate prices, as well as the scar tissue related to zero COVID. So you've got that taking place. So one, you'd say Q2 earnings on the horizon. You have these government meetings, but the other thing in terms of going into the Q2 is the incredible buybacks taking place in Chinese companies, particularly the internet companies that we're obviously owners of in our China internet strategy. But why the internet companies in particular is the founders or the CEOs and the senior leadership of all of those companies. And if they felt China's economy or their company's prospects were going to be so bad, why are they buying so much stock back? The question is that they think there's an opportunity. And so we think that will, at the least, drive bottom line earnings per share growth in Q2. And so we think there are some positives coming over the next really month, as well as more specific to Alibaba, its potential inclusion into Southbound Stock Connect. So Southbound Stock Connect allows mainland investors to buy Hong Kong stocks. Alibaba's excluded from that. In the case of Tencent, it's 9% of their shares are owned by investors in China. Meituan, the restaurant delivery company, it's about 13%. For Alibaba, it's 0%. That could change in September if they can get their primary listing converted to Hong Kong in August. So there's some positives coming. And, again, it's off a very low investor base. There's no skeptics remaining. And so we actually see some positives happening. I mean, I guess the asterisk is like any good long only manager, you have a bullish bias.
Yeah, you make some good points about what's available and where, but I mean, we know well about China's success when it comes to electric vehicles. They're making a lot of progress in the AI space. When you buy a China ETF, do you get, or how much exposure do you get in these areas?
Yeah. I mean, certainly, it's interesting that, for kind of, self-serving by, the kind of K-web companies, the internet companies, because of their investment in technology, big data, they become the natural players for cloud computing as well as AI. And people have said, well, isn't that a risk if the U.S. government's trying to cut China off? But it's interesting, actually, in the Q1 earnings for Baidu, they talked about, well, listen, if you can't buy a high-end NVIDIA chip, you buy, making this up, 10 lower end, and by putting those 10 lower quality chips together, you get one great chip. So the companies have been able to navigate some of the export restrictions just by buying larger amounts of actually less expensive chips. But yeah, the AI space, Baidu is the very clear winner in the space. You're seeing that with their rollout of robo taxis in China. But certainly, all of the big internet players are very involved in cloud and AI, and are the very clear winners. Now, they get no reward thus far from investors for it, but we think that potentially adds a little bit of this rotation out of Mag 7 and U.S. U.S. mega cap tech names into everything else. Why wouldn't you put a piece of that into cheap China? It makes sense to us. The valuations are at such discounts to their U.S. or global peers. And I think that's another factor at play with a potential Trump presidency is a weak dollar. I mean, that's not just the low taxes, continued government spending, but potentially deliberately trying to weaken the dollar to help U.S. exports. But that would certainly benefit non-U.S. equities, including obviously EM and China.
And do you think KWeb, which you just mentioned, Brendan, is the ETF, the China ETF that looks the most interesting right now?
I mean, I do, just because I think I don't think China can rally without the K-web companies rallying. That if I need to buy an energy stock, do I want to buy Sinopec if I can buy Exxon Mobil? Or do I want to, why would I buy ICBC if I can buy JP Morgan? But if I want to get real exposure to domestic consumption in China, it's going to be the Alibabas and Tencents and JDs and Netties and Pinduoduos and TripDoc. So I just don't believe China can rally without those names. At the same time, just empirically, not all of MSCI China is seeing improving fundamentals, right? Energy companies are dependent upon commodity prices, material companies are dependent upon commodities. Energy companies depend on oil and natural gas. Certainly, financial companies in China, no different than here in the U.S. Low interest rates is problematic. Low net interest margin generated. So yeah, it's interesting that some of the sell side strategists are very focused on the internet space, very specifically because of the improving fundamentals, and that is not true for MSCI China taken as a whole. So I do like it. I do think other areas where investors can focus would be electric vehicle, and it's not. I should restate. It's in meeting with BYD a few months ago, the global leader not only in electric vehicle but in hybrid technologies. They spoke about, we don't get any credit for what they've done in hybrid, and they were big proponents of hybrid as a transitionary technology for big countries like China and the US, for countries that have really cold climates up north, like China and the United States. And certainly, outside of the US, Chinese EVs are becoming ubiquitous, but also they're hybrids. And so I think that's an area. Certainly China, it's almost a shame, but because of U.S. government policy, they're going to develop their own chip self semiconductor resiliency. That won't happen overnight, but it's happening, and that will be a big problem for Qualcomm, for Texas Instruments, and others. Not soon, but in the years to come, these policies will hit. But anyway, yeah, semiconductors is an area where there's a lot of focus on R&D and self-sufficiency, and that's solar, wind. You can ban it here, but the rest of the world will buy from China for solar and wind technology. So renewables is an area that we continue to like as well.
Well, fantastic. Brendan, we're going to have to leave it there. You gave us a ton of great insight. Thanks so much for your time.
My pleasure. Thank you both.
It's Jeff here with ETF.com. Make sure to tune in to the next episode of Exchange Traded Fridays, available wherever you get your podcast.